Tesla's $12,000 Model 2 promise sounds revolutionary, but the math behind it raises serious questions. Claims of 45-second assembly versus Mercedes's 8.7 minutes, and structural batteries enabling sub-$12,000 pricing seem almost too good to be true. What's actually feasible here? We'll examine Tesla's cost breakdown claims, analyze whether their manufacturing innovations can realistically support this pricing, and separate the legitimate breakthroughs from the marketing hype. Let's dive right in. Tesla's most audacious claim centers on their revolutionary 45-second assembly time, compared to Mercedes's 8.7 minutes per vehicle. That's not incremental improvement. We're talking manufacturing speeds 11 times faster than established automakers. But here's what most coverage misses. The physics and economics behind this claim reveal both breakthrough potential and concerning gaps. Let's start with what's actually achievable. Tesla's unboxed process fundamentally reimagines automotive assembly through parallel production stations. Instead of sequential line manufacturing, multiple subsystems converge simultaneously. Think of the difference between building a house room by room versus having electrical, plumbing, and framing crews working in parallel coordination. The structural battery integration drives much of this speed advantage. By making the battery pack the vehicle's chassis, Tesla eliminates over 300 individual parts and several meters of welding. This isn't just efficiency, it's architectural revolution. Traditional automakers build a chassis, then install a separate battery. Tesla builds the battery as the chassis. But here's where the numbers get interesting, and we'll return to this critical point later. Tesla reports using 73% less steel per vehicle through structural design, dropping labor requirements to 2.1 hours versus Mercedes's 14.3 hours. Their supply chain integration reaches 67% vertical control compared to Mercedes's 23%, cutting middleman costs and delays. And here's what few people realize about their cost breakdown. Tesla's detailed analysis shows $4,200 for the 60 kilowatt-hour LFP battery at their negotiated $70 per kilowatt-hour rate. Structural components cost $1,890 using single-piece casting. Electronics and software add $1,420, leveraging existing full self-driving infrastructure. Manufacturing and assembly total $2,100 with full automation at 10 million unit scale, even adding $2,149 for profit margins and R&D recovery. The math reaches exactly $11,759. But there's a crucial detail that challenges this entire calculation, one that becomes clear when we examine their battery breakthrough. First, though, let's address the elephant in the room. Tesla's Giga casting technology uses 6,000 to 9,000 ton presses forming front and rear underbodies in single shots. This replaces dozens of stampings and hundreds of spot welds. When operational, it's genuinely revolutionary. But here's what's rarely mentioned. Each press costs over $100 million, requires perfect part dimensional accuracy within 0.1 millimeter, and any malfunction shuts down the entire production line. The risk calculation becomes stark when you realize Tesla needs dozens of these presses operating flawlessly to hit their volume targets. One press failure could cascade through their entire cost structure, pushing that $11,759 price point well into the $15,000 to $20,000 range, where competitive dynamics completely change. This leads to a remarkable discovery about how their battery strategy either enables or destroys this pricing model. Tesla's next-generation nickel-doped cathode represents either their greatest breakthrough or their most dangerous assumption. VP of Vehicle Engineering. Lars Moravi confirmed this chemistry enables 90% daily charging versus the traditional 80% nickel battery limit. This seemingly minor change creates massive cost implications that few analysts have properly calculated. Here's the engineering reality behind the economics. If drivers need 200 miles daily range at 4 miles per kilowatt hour, that requires 50 kilowatt hours of usable energy. With 80% charging windows, total pack size must be 62.5 kilowatt hours. With 90% capability, the pack shrinks to 55.6 kilowatt hours. That 6.9 kilowatt-hour reduction saves approximately $800 per vehicle at current battery prices. But this is where things get interesting, and it connects directly to a problem we'll explore in the next section. Tesla's patent applications reveal the doping process involves introducing trace stabilizing elements during cathode synthesis. Internal testing shows capacity retention improving from 83% to 91%, while long-term degradation drops from 20% to under 5% across 1,000-plus cycles. The chemistry breakthrough sounds impressive until you examine the production requirements. Precise doping demands exact temperature control within plus or minus 2 degrees Celsius, contamination levels below 10 parts per million, and batch consistency across millions of cells. Any deviation destroys the cost advantages and potentially the entire business case. And here's what's truly noteworthy about Tesla's battery strategy. They're simultaneously scaling LFP production for megapack storage, theoretically freeing high nickel capacity for automotive applications. This dual chemistry approach optimizes their supply chain, if executed perfectly. The Nevada Gigafactory expansion adds 100 gigawatt-hours annually, enough for over 1 million compact cars, while their Corpus Christi lithium refinery targets 1 million vehicles worth of battery-grade material. But there's a detail most people overlook in this supply chain calculation. Tesla's cost projections assume $70 per kilowatt-hour battery pricing, yet industry averages remain around $115 to $139 per kilowatt-hour. This gap suggests either Tesla has negotiated unprecedented supplier agreements or their cost model contains optimistic assumptions that could unravel quickly. Why would Tesla accept this risk with unproven chemistry at massive scale? The answer reveals their broader competitive strategy and potential vulnerabilities. As we'll see in the final analysis, the stakes extend far beyond a single vehicle model. What happens if even one of these technical assumptions proves incorrect? The cascading effects could reshape not just Tesla's future, but the entire trajectory of affordable electric vehicle adoption. And here's why this changes everything about global automotive competition. The Model 2's claimed $11,759 pricing creates what economists call a discontinuous market shift, fundamentally changing customer expectations and competitive dynamics. For American families, particularly those over 65 on fixed incomes, this pricing translates to $89 monthly ownership versus $847 for comparable gasoline vehicles. That $758 monthly difference represents genuine financial liberation for millions of households. The 10-year ownership comparison amplifies this disruption. $32,520 total costs for the Model 2 versus $101,640 for equivalent gas vehicles. That $69,120 savings invested at 6% returns becomes $123,891 by retirement. Tesla isn't just selling cars. They're restructuring personal transportation economics for an entire generation. But here's the question that determines everything. Can Tesla actually deliver these economics at scale while maintaining profitability? The competitive implications depend entirely on execution precision that automotive history suggests is extremely difficult to achieve. Chinese manufacturers like BYD have dominated affordable EV segments precisely because they've mastered cost control through different approaches. BYD's Seal 6e launches in Malaysia with 218 PS, 330 Nm torque, and 545-kilometer range. Competitive specifications at established pricing. Tesla's strategy attempts to leapfrog this competition through manufacturing revolution rather than incremental improvement. The manufacturing approach creates significant competitive moats if successful. Competitors attempting to replicate Tesla's Giga casting and structural battery integration need massive capital investments in new tooling, factory redesign, and supply chain restructuring. These barriers could protect Tesla's cost advantages for 3 to 5 years, assuming their initial execution succeeds. However, the risks of this all-or-nothing approach become apparent when examining automotive industry precedent. Ford's attempt at revolutionary manufacturing with the Model T succeeded because they simplified the product while revolutionizing production. Tesla is simultaneously revolutionizing both product architecture and manufacturing processes, exponentially increasing complexity and failure modes. What happens if Tesla achieves even 80% of their targets? At 8 million annual units instead of 10 million, their cost structure changes dramatically. Fixed costs for gigacasting equipment, R&D amortization, and facility overhead get distributed across fewer vehicles. That $11,759 target could easily become $14,000 to $16,000. Still competitive, but no longer revolutionary. And here's what's truly critical about Tesla's timeline. Their promising production begins in late 2025, reaching volume in 2026. This aggressive schedule assumes flawless integration of unproven technologies at unprecedented scale. Automotive launches typically require 2 to 3 years of production refinement before achieving target costs and quality simultaneously. The ultimate success metric isn't whether Tesla builds the Model 2, but whether they profitably manufacture millions annually at promised pricing while maintaining their premium brand positioning. Success would demonstrate that American manufacturing innovation can reclaim global automotive leadership through technology rather than labor cost advantages. Failure would reveal the limits of even breakthrough engineering in overcoming fundamental automotive economics. That quality, scale, and affordability remain an extremely difficult triangle to optimize simultaneously. But there's one more factor that could determine the outcome, something most analysts haven't considered. Tesla's full self-driving technology, already developed for premium models, gets distributed across millions of affordable vehicles. This creates a potential revenue stream through software subscriptions that could subsidize hardware costs, assuming regulatory approval and customer adoption rates that remain highly uncertain. The Model 2 represents either the democratization of premium electric transportation or the most expensive lesson in automotive manufacturing complexity. Either outcome will reshape industry expectations for the next decade, determining whether breakthrough innovation or evolutionary improvement dominates the transition to electric mobility. What's certain is that Tesla has committed to the most ambitious automotive manufacturing challenge since Henry Ford's assembly line, with implications extending far beyond their company into the future of American industrial competitiveness in the 21st century. This is exactly why Tesla's $12,000 Model 2 represents more than just another EV launch. It's a test of whether American manufacturing innovation can fundamentally reshape global automotive economics. The ambitious claims we examined aren't just marketing promises. They're engineering commitments that will either validate revolutionary manufacturing approaches or expose the limits of even breakthrough technology. What this means is simple. If Tesla succeeds, they'll prove that vertical integration, architectural innovation, and manufacturing revolution can overcome traditional cost barriers. If they fall short, it demonstrates that automotive fundamentals, the delicate balance of quality, scale, and affordability, remain as challenging as ever, even for the industry's most innovative companies. The broader implications extend to America's industrial renaissance. Tesla's approach represents a uniquely American solution, using technology and innovation to compete rather than chasing lower labor costs. Success would signal that advanced manufacturing can anchor high-value production in the United States for decades to come. And this is just the beginning. Production starts in late 2025, with volume delivery targeted for 2026. We'll be tracking every milestone, from Giga casting efficiency reports to real-world battery performance data, as Tesla's boldest manufacturing experiment unfolds in real time. What's your prediction? Will Tesla hit their $12,000 target? Or will manufacturing reality force pricing closer to $15,000 to $20,000? Drop your thoughts below. I'm genuinely curious whether our community sees this as achievable innovation or ambitious overreach. This is Tech Revolution, and we dive deep into the engineering breakthroughs reshaping industries. If analysis like this helps you understand what's really happening behind the headlines, hit subscribe. For the latest developments in manufacturing innovation and EV technology, you know where to find us. The next 2 years will determine whether Tesla's Model 2 becomes the democratizing force in electric transportation or the most expensive lesson in automotive complexity. Either way, we're witnessing history in the making.